Hi, my name is Melissa Fish. I am the owner of Fish Legal Counsel and a corporate and mergers and acquisitions attorney. So today I'm going to talk to you guys about a checklist for acquiring a business. So you've decided to acquire a business. Exciting and often a huge milestone for people. I'm going to walk you through sort of beginning to end what you want to know about acquiring a US-based private company. So we're going to cover the preliminary steps, kind of questions you want to ask yourself going in. We're going to talk about deal structure, what your options are, the initial documents you want to have drafted, as well as the main principal purchase agreements. And then we're going to talk a little bit about due diligence, what that looks like, and sort of what you want to be investigating when you're buying a company. Okay, so what we're not covering: antitrust, employment and executive compensation, and tax. All can be relevant, important, but I'm not talking about it here. Okay, so let's talk about preliminary steps. What are the questions you want to ask yourself? The very first thing is, who do I need in my circle in order to go through this transaction? Whether that is an attorney, financial advisor, accountants, who do you need on your team in order to actualize this deal? You want to identify the business goal for the acquisition. This is going to inform the structure and a lot of other things throughout the process. Are you trying to expand manufacturing in a certain geographic area? Or are you trying to consolidate with another business in your industry to take up more of a market share? Maybe you're just looking for a complementary product or service. Next, you want to think about how much due diligence you are going to need for this deal. So some of the things that inform that are how much you know about the company. I mean, are you an employee that has worked for the company for years and you know the ins and outs? So due diligence can be limited. Do you work in the same industry already and have an idea about this company? Does it have a reputation? Do you have a prior commercial relationship with the company that you're buying? All those things are going to give you an idea on how deep the investigation needs to go. You also want to think about how you're going to structure and finance the deal. Are you going to buy assets or stock? And are you going to finance it with cash, or are we looking at a promissory note or some kind of equity exchange? And finally, think about how you're going to integrate the business after it closes. A lot of people don't think about this because it's something that's so in the future and it's like, is it even going to close? But it can inform aspects of the deal when you know what it's going to look like after close. So, for example, um, IT systems or business functions. Are there going to be aspects that are duplicative? How can we avoid that? What are you thinking as far as notifying customers or vendors? How are we going to inform them the business has been purchased? Okay, let's talk a little bit about deal structure. So generally you have two options outside of like a merger, and that's to purchase the assets or substantially all the assets of the business, or to purchase the stock. Um, Asset purchases are very popular because there's some tax benefits to it. You can get a stepped up basis in the assets. We're not going to go into the tax. I said I wasn't going to do it, so I'm not going to do it. But there are tax implications. Just really like bird's eye view. Asset purchase, you get to elect which assets, which liabilities you're purchasing. If you're not buying them, they stay with the target company and you never have to think about them again. There's no change in the corporate structure. Now, it can be more paperwork and possibly, you have to be a little more focused and careful just because you don't want to leave any important assets on the table. You're literally picking and choosing, handpicking everything that you're going to purchase, including the chairs in the office. Like if they're not in there, they're not yours. The other option is stock purchase. With that, there's the convenience of all assets and liabilities just transfer as a matter of law, right? So you don't have to think about which assets you're buying or not. The downside is if there's unknown risks or liabilities and you haven't properly mitigated for those risks or gotten representations and warranties and good indemnification that will help protect you, you could end up holding the bag in a way that you didn't intend. Generally, that's going to be more due diligence. That's part of how you protect against that kind of issue, right? Like, let me really look into what I'm purchasing because I'm taking the baby with the bathwater here. Okay, let's talk about initial documents. You usually start off with a term sheet. Term sheets are generally non-binding except for the confidentiality provisions for obvious reasons, and exclusivity, which basically says that the target can't negotiate with other parties during the exclusivity period. You want to be conscientious of the timeline of the term sheet, because if you don't sign the principal agreements within the time period that the term sheet allots, you might spend a lot of time and money and have a seller that just walks away, which sucks. So, yeah, and sometimes people don't know that the term sheet's non-binding. They treat like MOUs or term sheets like they're the formal agreement, move forward, send money, all this stuff, and well, you can imagine how that can go wrong. So now let's move on to the actual binding documents, the principal agreements. So it's the purchase agreement, right? Whether it's asset or stock acquisition agreement. The agreement often is going to reference a lot of ancillary agreements as well. So for example, if you're financing it, there might be a promissory note, there might be a security agreement. I see a lot of transition services agreement, whether that means the previous owners are going to stay just for a short period of time in order to help you transition, or a full-blown, consultant position, or even W-2. So yeah, these agreements are going to be binding. This is where all the terms are going to be decided, and they're going to be heavily informed by what happens in due diligence. So let's talk about due diligence. What does it mean? What does it look like? After the term sheet is signed, the buyer begins the due diligence process, right? And then the principal agreements are kind of getting prepared alongside the due diligence process. Sometimes you might even have third parties involved if you need like forensic accounting, or if you want to understand business operations. There's plenty of companies that are happy to take your money to do really good work on helping you understand what you're going to be purchasing. So depending again on what your relationship is with the company, how much you know about it, it might be worth it to know things ahead of time. I've definitely seen people discover things in due diligence that materially affect purchase price or other, terms of the deal. You have to mitigate for risk that comes out as you're doing your investigation. So that's what due diligence is about: uncovering unknown liabilities and risks, and then using that information to integrate it into your principal agreements to make sure that you are not taking on anything that you didn't expect, and that anything you are taking on is being recognized in the terms of the agreement. So what do you ask for in due diligence? I generally provide a due diligence request list. What's on there is going to change based on the industry, the company, your relationship with them. But in general, you want the organizational documents, right? You want to see how the company was formed, what state, is it in good standing? If it's a corporation, you want to see board minutes, that things have been in compliance as far as the formalities. Are there loan agreements? Was there an SBA loan? Was there any other liabilities that you should be aware of? You want to understand if the people that are saying they're going to sell you a company actually have the authority to do so. So sometimes that means looking at, title to assets, financial records, insurance policies. Depending on the type of company, you might want a customer list. Is there subscriptions, or is there like contractual relationships with clients? I had a deal where we were doing due diligence. We asked for key contracts, realized that one of them was about to expire. That made up a material portion of the revenue. So that definitely changed the terms, and it gave us a little leverage on some other aspects of the deal in regards to holdbacks, earnouts. That gets more into the weeds. Don't worry about it. I'll handle it. And then, key contracts with vendors or key suppliers. Once due diligence is complete and the parties have finalized the agreement, we move into the signing and closing of the deal. What that looks like in real life is either meeting up in person to get things signed, which is becoming less and less common. Oftentimes you can just have the signing all electronically and over email. It can happen simultaneously. The purchase price is then paid as soon as the documents are signed. You pay it based on whatever you've determined in the purchase agreement, whether that's, oftentimes it's wire instructions, and the buyer will wire over the funds. And then you move into integrating your new purchased assets or stock into your business. So that's it. Easy enough, right? Once again, I am Melissa Fish, corporate and mergers and acquisitions attorney and owner of Fish Legal Counsel. Hope this helped.